we are good to go for another week here at Selfwealth Live, which is our technical analysis edition here on the 25th of February 2025. G'day, Jace. How are you today?
Hey, Rog, I am good. Plenty to talk about today, don't we? It's a pretty interesting week in the market. So, yeah, I think we've got should be an interesting show.
Yeah, I wonder if are the gurus claiming doomsday just yet, or what? Are they claiming that title?
Oh, I don't know. I don't keep tabs on too much of the what goes on out there with other people's chatter. For me, it's like I keep it simple. I turn down the noise by not looking at a whole lot of other stuff. I've got a few select things I'll have a look at, or people I might listen to see what they're thinking. And but to the most part, it's like I look at the charts, I assess the price action, and I apply rules. So it tends to be able to like take out a lot of the confusion, a lot of emotion. Than when you're listening to 1,000 other people, you got the news feed on, and yeah, it can get pretty ugly in these times.
Now, of course, I mean, obviously I said gurus, but then we probably claim that we're kind of gurus as well on this show. I mean, more like news headlines, right? So, but we'll get onto the charts very soon, obviously. Welcome, everyone. Welcome to the show today. If you are a new person to the show, welcome to our Self-Wealth Live. We're here to obviously talk about charting and how to read the charts and how to enter and exit trades based on our theory and our ways of doing things, right? Obviously, there's a million different ways of doing things, but we have our ways of doing it. Obviously, our show has evolved quite a lot, but for what it is today, we will analyse our Australian market, we'll analyse the US market in general, and then we'll also analyse the Hong Kong markets. If you've got any general questions, then please add them to our feed here, live chat. And then we'll analyze your tickers as well. So make sure you put your tickers in nice and early because there will be a time we'll have to sort of cut off because obviously we get quite a few each week. So, but yeah, hopefully we get quite a few again and we can have a look and see, assess what's going on there in the markets. Jace, before we get going, let's have a look at that disclaimer for us, please.
Yeah, so just quickly, everything today is general commentary only, no personal advice. I'm also not part of Selfwealth. My business is Motion Trader, so you'll see my details up the top, licensing, etc., general commentary, and then beneath there we've got Selfwealth, same thing, licensing, general commentary. And having said all that, that probably sets us up to be ready to go.
All right, beautiful. All right, so we're already getting some of the tickers come in, but we shall start with our Aussie market. There has been quite a few down days since we last spoke last Tuesday. How's it looking?
Yeah, so let's have a look at this. Have a look at this first. So I got the ASX 200 up here, and it will. Yeah, Rog, you're right. It's certainly been a big week, and probably not the big week in this way that most of us would have liked. This has been a 5% swing from the high on Thursday the 13th, so a bit over a week ago, to where we currently are, 5%, and that opens the question of whether there's more to come. I think in these situations, what I always find interesting, it's to look at major peaks from other periods, see what they look like, because I think they can help shape our structure or shape our thinking around what the price action we're currently seeing is. And I did something similar in my weekly strategy session last Friday, so I thought it's probably worth doing so again now. We could do this all day. There's so many peaks to look at over the decades, but let's just look at a couple just to give us an idea. So the first one I want to do, we're just going to go back to 2021. 2021 peak in the market, so we had that big rally after the COVID lows, and what you'll notice through here is that the market took several. It was a multi-month. It was a large topping process. It actually took months. So we've got the high in August 2021. Then we get this multi-month consolidation where prices move sideways. So there's our initial quick fall from above the averages to below. But of course, that didn't then continue down in a straight line. It paused and rallied back to the averages. We've got all this consolidation. Got a false break to the upside in January 22. I'll come back and talk about false breaks a little bit later on. Then there's a panic sell-off, And now this is where the structure starts to change. There's a rally back to the moving averages, and then we start getting consolidation below the moving averages, which is something we talk about quite a bit. A rally, but then that rally wasn't able to hold on to the gains. There wasn't buying at the dip, and then more consolidation below the averages. So you're really starting to get that structural change start to come through. And then the selling really started to get underway, and that went on for several more months. So it was messy, it was difficult, but it wasn't a case of the market hitting an all-time high one day and then straight into bear market the next. It took time to develop. This whole period through here, it took many months to develop. Now let's go over and have a look at another situation where it unfolds a little bit quicker. And no, we're not going to talk about COVID. I don't think any of us should be really focused on this sort of decline. That was an external shock. It's a highly unlikely situation to reoccur. So let's not worry about that. Will reoccur anytime soon at any rate. What I want to go over to now, I want to look at heading into the GFC. So I'm just scrolling back to get to our spot. So this is heading into the GFC peak in 2007. So this is interesting because this was quicker. This unfolded quicker than what we just went through. So in this case, we've got the all-time high. Prices come back to the moving averages. They have a rebound, can't make it back to the previous high, and then quickly find themselves below the moving averages. The moving averages start to turn higher. We've got the consolidation beneath the moving averages. And then and as we often talk about, that's a point of vulnerability when prices are consolidating below moving averages. And then prices broke lower and momentum then continued and also accelerated to the downside. But again, it didn't happen in 1 week. It still took a few months to play out. So I'm not saying these things are easy to pick, far from it. And you only have to look to this period just to the left, where it's not a dissimilar sort of setup, but this turned out to be more of a panic sell and then a rapid recovery, not a trend change. So those short-lived panics can make it a little bit more difficult. But the point of this is that we often get clues when the structure has changed and we see the signs developing. It doesn't mean that they tell us when the top's going to be, but it's more a case of we can start preparing as the structure starts to evolve and starts to weaken. And one down week simply isn't enough time to see the price action evolving. And just by chance is a good example on this chart. Just cast your eye over here to this period in early 2007. So see that drop there from peak to high? That took about a week and it was 6.5%. So it's bigger than we've seen in the last week. And you can imagine the sort of headlines and dire commentary that was happening after that week. It would have been all sorts of things about the markets crashing, whatnot. But then within a month, month or two, it was back at all-time highs. So we've got to be able to differentiate between panic sell-offs and structural change. And we just don't have enough information to really get a handle on that at the moment. So coming back to where we currently are, as I say, we don't have enough to say there's a structural change going on in this market. Yes, there are things to be aware of and be cautious towards, but we don't have that concrete change to say, look, we're consolidating below moving averages, which are rolling. And at this stage, it's a quick sell-off from above the moving averages to below. We've seen two similar sell-offs in the last 10 months. Actually, we've seen three. So we have the one here from December. We've got another one here in August. We've got another one over here in April last year. And on each of those occasions, it was a case of the dip quickly being bought and prices being pushed back above the averages. So does that mean that this dip is quickly going to be bought and push prices higher again? Well, not necessarily. We don't know. This time could be different. No one's got that crystal ball to say that, no, this time's different. This one, this one's really going down. We don't know. No one can say that. Anyone who says that is making it up because I don't know. So it could happen, but we also could have a repeat of these past instances where prices quickly go back up. If I had to call it either way at this point, I'd be on the side of what has previously been working. That is, these dips have been bought. So I don't know what's going to happen, but often it's a case that the odds favour the status quo, and that being that dips have been bought. And I'll continue to do that until we see that structural change that I told you about earlier, where the dip isn't bought so well and we've got the consolidation below the averages. And that's when we start talking about, look, this looks really vulnerable now. And then you might get a breakdown and then the whole thing has changed. But we're not there yet. So this week's pullback, it definitely does some technical damage. I think at best, there's a high possibility of at least several weeks of consolidation, maybe several months. But I do think consolidation at a minimum is what we should be preparing for. And I think the next rally will tell us a lot. Is it going to be like a strong buy the dip rally like we've seen in the past, where the buyers really come in and really chase prices higher? Or is it going to be more of a muted bounce, which stays below the moving averages? So I think that will tell us a lot when we start to see that price action come in. And I've reduced some risk yesterday. Yesterday, I just scaled down my risk, and I also sold an S&P 500 position, which I sold that on Saturday morning, which was just before the close for Friday afternoon in the US. So I just saw. We'll go over the US price action in a sec, but based on what I saw on Friday, I just sold some US position down. I'm still long. I'm still long stocks, still long the market. I've just scaled back. So if I thought there was something dire about to happen, I'd sell out. But I haven't done that. I've just scaled back, just adjusting to the different risk situation as it's evolving. And as I said, a down week doesn't make a bear market, but there are some increasing risk factors I think we probably should take note of. And this is where strategies like those wide trailing stops come in that we always talk about. And so if this turns out to be more than just noise within an ongoing uptrend, well, then those wide trailing stops. Well, if it turns out to be noise within an ongoing uptrend, the wide trailing stops help me see it off and hold on to most of my good positions. But if it turns into something bigger and we do see a larger sell-off, well, I've got those calculated exit levels in place to get me out if and when the trend does ultimately change.
Okay, fantastic. It's good. It's good to have some perspective, and it's great to see. Look back. Many people probably wouldn't look at that. They'd just see a down week. And I kind of knew you were going to come back with that history and looking back at those most recent, down weeks. We could call them down a couple of weeks before pretty strong rebounds, right? So obviously we don't know what's going to happen, as you've said, but great to have that perspective and being able to see it as an overall picture, an overall market, rather than just the price action over the last week. So.
It's interesting, Rog. The future, we don't know, but the future is almost certainly going to be some variation of what we've seen in the past. So that's why we go back and we look at what's the sort of price action that's evolved in the past, and then we can see what starts to be constructed on the chart now and go, well, look, this is how this could go based on how, because price action is all based around human action. Buying, selling, emotion, it's all built into the price action. This is why the price action can help you understand what's going on. And then the structure, are we above moving averages, below moving averages? And how long does it take for a top to form? It's that's why I wanted to go through those examples, because you see that it's not a case of all-time high and then we're down 20%. You can get a crash, but they are real rarities. And it's more often the case that it's a top building process, and during that top building process you get some levels where you can say, okay, if we break below here, well, then I want to take more risks down and just keep adjusting. But if things stabilize and the sky doesn't fall, well, I don't want to have exited my entire portfolio. I might have to sit through a multi-month consolidation, then we get a breakout to the upside, and I want to add to that base, that core position I still have in place. So I think it's really important to be able to understand what's going on from a bigger perspective rather than just a snapshot of 5 to 10 trading days.
Yeah, fantastic. All right, well, let's have a look at the US markets then.
So this S&P 500 briefly made a new all-time high on Wednesday, and now it's quickly reversed course and back towards those moving averages. And the breakout, this all-time high, it also saw a breakout from a tight consolidation range. And I just quickly draw it in here. I think we probably would have spoken about this last week. You just see this compression. Prices, we had a nice strong round at the January low, sideways compression in the moving averages. It's normally a great setup that leads to higher levels. We got the breakout, but the breakout didn't stick, and prices have fallen back down. So that's a false break. And I'll come back. We'll talk a bit more about false breaks a little bit later on. And so I think at this stage, the moving averages are still rising, and prices just come back to the upper end of the moving averages, just below the 50-day, but above the 100-day. So when you look at the entirety of this chart, the underlying structure remains bullish. It's more bullish than the ASX 200, which has come to underneath the averages. At this stage, it's still a rising trend. Now, I want to jump over to the Nasdaq and spend a little bit more time on the Nasdaq today. That's been really interesting what's happened here, and this is a large reason behind what I did with my S&P 500 position on Saturday morning. And there's some I think this is an important price action. So the Nasdaq broke upwards from a 2-month trading range. You can see this period in here. That's a 2-month trading range where prices move sideways along these rising moving averages. And then last Thursday, a week and a half ago, prices broke high from this range. We've got this bullish breakout from a 2-month compression band. And now that would ordinarily be a bullish sign, and it was a bullish sign. It's a sign that you get all this pent-up energy during a compression, break to the upside. More often than not, you then get the follow-through buying and push prices higher. But that hasn't happened. Instead, prices have broken back down and now back within the range. So this here is what we call a false break. And false breaks are often warning signs. And the lack of follow-through buying following the breakout and the increased interest in selling into the rally, it's a sign of technical weakness. And if a market can't move higher when it breaks out from a range, well, then it's typically going to have a test to the downside. It doesn't mean it's going to completely come apart, but it's going to test the downside, see what's there, see what sort of buying interest is beneath what sort of buying interest is at lower levels. Now, this doesn't mean this overall trend, which has been in place for well over a year, doesn't mean this trend is over. I think a lot more needs to happen before we can say that we've now got a market which has broken down and the trend has changed. It's far too early. This is from the all-time high. It's we're 3 or 4 days in. It's far too soon. But I think that the price action does suggest, this false break in particular, I think the price action does suggest there is cause for some concern, or not concern so much, but caution. Cause for caution, and then maybe a scaling back of risk. And because of this false break, that's why I sold my S&P 500 position on Saturday morning. I bought it on the breakout. The breakout didn't continue forward, and we've got a breakdown. I know this is the Nasdaq, not the S&P 500, but of course they're highly correlated. And so I just go, okay, that didn't work out for now, so I'll just take that risk back off the table. If things stabilise and break higher again, great, I can go and put it back on. But I don't need to be in that position now because I bought based on strength off moving averages. Now that hasn't played out, there's the reason for holding it is not there. So I've just scaled that back. And as always, with all my positions, all the individual stocks and everything else I've got, I always want to know where the exits are because at some point conditions will change, whether that be happening now or whether it be in 6 months' time or a year's time or whatever it may be. conditions always do change. So I think it's always important we have a structured exit plan, and we're not just turning on the news or reading the papers or the internet feed or whatever and going, oh, look, Marcus had a bad week, I better sell some stuff. It's like, well, no, that's not a plan. That's just reacting to the headlines. Have a plan where you calculate it out and you go, okay, if this happens, well, then I need to do that. I need to reduce risk by maybe a third or a half or a quarter, or maybe I just got to exit a few stocks which are starting to fall below their averages and pick up some downward momentum. Just having a plan, so it takes the emotion out of it, and you then, it's like a checklist. You just follow it as the markets evolve, and it helps for making emotional decisions at bad times.
Okay, fantastic. All right. Well, Hong Kong's kind of the opposite over the last week. It's gone up. Let's have a look at that.
Yeah, well, this is certainly doing something different to at least the US and the Aussie market. Further strength over the last week. Prices are now above the October high, and they are really getting stretched above these moving averages. Now, I said the same thing last week. I thought they were getting stretched above the moving averages then. Where's last week? Last week's just here, and they've gone even further. And that's the thing. Prices can always get more stretched. So this is why I'll often say when we're in a bullish phase and we've got long positions in stocks, it's like stay with the trend, see where it goes. Don't try and get too clever by saying it's gone far enough, I'm going to take profit. See where it goes, give it room to move. But I think as prices do get stretched, I think the odds of a pullback do increase, and that's where things stand, at least in my thoughts. This is where things stand with the Hang Seng. The odds of a pullback are increasing with the more it gets stretched above these moving averages. Also, it's kind of doing its own thing at the moment as well, which is maybe, and it's diverging from China. We'll get to in a sec. So it's like I just don't know that this would be a great risk reward entry point. If I was long, I'd be happy to stay that way, wide trailing stop. But chasing it up here doesn't seem to be a strong risk reward play in my eyes. I'd rather wait for the next pullback, consider an entry point then. Looking at the Chinese market, continues to lag. It's above these moving averages, back above the moving averages, but it still lacks any real momentum. It's just not getting much gusto to it at all. It really is. You'd probably still say, look, this is really essentially a range bound market. It's not. It doesn't have downward momentum, doesn't have upward momentum. So in which case, it's really a sideways market. One to keep an eye on. If we do start seeing prices breaking up and breaking above some of these previous highs, like from December, early December and late December, we start seeing those old highs get broken. Well, then maybe some momentum's coming in. But yeah, look, I think probably not for me at the moment. I don't think there's a need to open new risk in this market, with particularly with volatility generally in markets. But don't ignore what's happening in the Hang Seng. It could flow on. There could be a broader story happening, but it's just we don't have that momentum at the moment to go off.
All right, fantastic. Good overview of the markets there. We probably touched on it a little bit throughout that overview, but let's get on to this general question here around, first of all, Jagjit says, thanks both. Love learning from you so much, which is great. Thank you. What is your view on buying the current dip? Could you please share an example of when buying the dip makes sense, Jason?
Okay.
Question without notice.
And that's all good. Buying the dip. Look, I sometimes buy the dip, but I more often than not buy breakouts. It's just my preference. There's nothing wrong with buying a well structured dip. So the sort of dip I prefer to buy is when prices come back to the moving averages and start to quickly stabilize and push higher. Or it could be a situation like we had during June, where prices were moving sideways along rising moving averages. Like these can be areas to buy dips, and then you can just have a stop loss a little bit further below the 100-day moving average. You've got to give it a bit of room to move around, because you can see prices do have these excursions beneath the averages, which then are quickly reversed. So the 100-day moving average on itself isn't like a magic line which can't be exceeded. So buying a dip as prices come into those averages with a stop a little bit beneath, and it might only be like, maybe 3%. It could be a relatively tight stop. Individual stocks, it can be a little bit different. Maybe it could be 5 to 7%. Individual stocks will move more than the index. When I don't buy a dip, like I wouldn't have been keen to buy this dip in August, because we've got prices below the moving averages. And that's where we are now. We've got prices below the moving averages. So it hasn't been a gentle pullback into the moving averages. We've had a quick decline from above to below. Now, it may turn out like it did in December and prices quickly rebound, in which case someone's saying, oh, look, I was really clever. I bought below the moving averages and it snapped back. But there's always the risk that it doesn't, and prices slide further before they rebound, and then the rebound might lack momentum, and I don't really want to be there. So in this situation, I wouldn't be buying. I'd be watching. And as I've said, I've scaled back a bit of risk. And then of course we've got these periods below moving averages. For me, these are definitely dips not to buy, because you're buying something where the average price is in decline. I don't want to buy a dip when price is below the moving averages. I want to buy dips when they're above rising moving averages.
I think that's a great response. And to be honest, it's kind of I know you wait for breakouts, Jason, and you sort of get them there at that breakout point. But I'm exactly what you explained there, waiting for it to come back to the moving averages and starting to turn around. Now, obviously, every opportunity doesn't do that, right? But there's just so many opportunities out there that you can't get into everything, right? So,
and look, not even dip works. And this stock may well come up in the Q&A, but I just jumped to it now, because it's a stock which I had myself. It's one of the stocks I've just sold up. It's like IDX. So this was a nice textbook consolidation along moving averages which were rising, and I bought this dip back on around about the when was it? Might have been just starting to see the price was just starting to rally off. I think it might have been around the 13th of December. I bought some shares in this, thought, look, maybe this is now rallying, it's going to break above these highs. Often I'd buy a breakout. You can see that blue line, but I preempted it. I bought the rally off the moving averages, which is completely reasonable strategy. But it didn't. The momentum didn't stick, and it started to break down on Friday. I just sold my stake in it yesterday. I've just taken a small loss. So, how big is that loss? Roughly, it's about 5%. Took a 5% loss. Now, had it broken to the top side and run, might have doubled. Could have been 100% winner or more. But it's been a 5% loss. So that's okay. There's nothing wrong with buying a dip that doesn't work and saying, okay, it hasn't worked, I'll just take a 5% loss. If you do that, 5, 6, 7, 10 times, you're probably going to get a few that run, and one or two of them might run a long way. So if you're just losing 5% or so every time you have a go, I think you're really keeping your downside low whilst giving yourself great upside potential, and that's what it's all about. Now, this could stabilise here. There's always a possibility that this is all just now part of a trading range, and it could base here and just continue to go sideways and then go higher again. But then I keep bringing my stop down and say, oh, well, look, I'm going to give it a bit more time. I'm going to give it to here. And then if it touches there, well, maybe I needed to give it a little bit more room below this previous low. So I'll set my stop down here. And then all of a sudden, my 5% stop becomes a 12% stop. And that can be okay. But it can get a bit of a slippery slope where you keep lowering your stop to give it a little bit more room. So my play was to buy the rally off the moving average. That didn't work out, so I just closed it out rather than looking at the chart and going, well, now I can find an excuse to keep holding. It's like, don't need to do that. That one didn't play out. Take the money back out. Bit of volatility in the markets, and I can redeploy it later on when something else sets up. But as I say, this could stabilise and run again. Maybe I'll buy it again if it breaks out. But if it doesn't, and if it keeps coming off, well, I've just shut down the risk and sit on the sidelines for a little while.
All right, fantastic. We'll get on to one more general question here. Excellent work for you, Jace. Well done. Quick question. It's from Neil, Dr. Neil Dan. How do you use a volatility filter to avoid stocks that tend to bounce around?
I don't. Oh, look, a volatility filter. It's something I use with the Motion Trader service, and a big part of that is removing some of the lower price stocks, which are just prone to they might spike 50% and then they'll quickly come back and give all that gain back. So helps me avoid the most volatile stocks. I usually don't want to filter too much. The more you filter, like a filter will collapse. The downside of using a filter is that it also filters out a number of good stocks that you want to buy, breakouts which do have some volatility to them, but can be managed through a trailing stop. So the more you filter, the more good stuff you take out, as well as the stuff, the rubbish that you don't want. I try to filter when I do scans. I want a pretty broad filter that lets most signals just play off their merits. So it's not something I use a great deal. It's more, volatility is probably more something I use with a trailing stop. So if there's volatility in a stock, I want to use that in the calculation for setting the trailing stop. So I'm not using a cookie cutter 25% or a 20% trailing stop for everything. And I think that's often what you find. People use like a 10 or a 15 or a 20 or 25% trailing stop for all their positions. But one stock might need one trailing stop because it's fairly stable, and then another one might be a stock which is just rallied 50% in 3 weeks. It's going to need a wider stop. There's more volatility in the share price. So that's probably what I'm using volatility more. I'm using it for managing the risk of active positions rather than staying out of stocks. In terms of staying out of stocks, it's like if a stock is stretched above the moving averages, I'm more inclined just to hold back and wait. But yeah, it's mainly just go with the breakouts for me.
All right, fantastic. Well, let's get on to. Actually, there was one other question here which we might just quickly brush over, since you talked about exiting one of your positions in the US here. On the ASX, are units in the SPY fully exposed to US currency?
Yeah, it depends which one you have. I think of the there's I think it's at IVV. Yeah, so there's IVV. So there'll be different ETF providers as well, but this is just one. I think there's an IVV. Is there an IVV? I think it might be. No, I can't remember. But there's one with a H in it. There's like, if you buy this one here, IVV, it's an S&P 500 ETF, and that's listed on the ASX, and that's the currency movement is going to impact the price of this as well. So it's not just S&P performance. You've got currency risk in there. So if the Aussie's falling and the S&P's rising, you got a double benefit. If the S&P is in decline and the Aussie's rallying, you got a double negative going on. But there are S&P 500 hedged ETFs which you can get, and just Google it. ASX. I guess you just Google ASX S&P 500 hedged, and you'll probably get several options. So it will just take that currency component out.
Yeah, fantastic. And you could probably do a bit of a search on the Selfwealth platform there, and you got to find them as well. All right, let's get on to some. Did you just look up IVV, because that was the suggestion? Oh yeah, IVV. All right, yeah. Fantastic. Let's start having a look at some tickers here. We've got quite a few as per normal, so let's get through as many as we can. Starting with RUL, please. RUL.
So I've got a few of these myself. Is the structure starting to change? So we've had it had been a nice rally. Now we're consolidating below these moving averages, which are turning lower. I'd say if we see a break below the February low, we probably start to see some more follow through momentum to the downside. It's been a strong, like this rally from a couple of days ago. That's a nice rally off the low. So prices seem to break below these previous lows, and instead of follow through selling, we've got this snapback rally. So it's really, I think this is really the line to hold. It's not a dip I want to buy. I've got some. I'm using the wide trailing stop. So if this low point breaks, that's not my exit level. I'm using my calculated trailing stop, which I don't know where it is offhand, but it's somewhere lower. But this is probably a point to say, well, if that breaks, the structure is really starting to turn to the downside from rising above rising moving averages to then gaining momentum below what would then be declining moving averages. At the moment, it's kind of holding in there. I'm still holding mine. I'll keep doing so till the trailing stop hits. But it's it's on the list of stocks which are becoming vulnerable to the downside.
Okay. PPS.
And I got some of this one too. And this had been going well until today, so I hadn't seen today's decline. At the moment, the trend's still in place. It does technical damage. I actually call this an island reversal. It's a technical structure where you see that. So like it gaps higher, and you get a consolidation period, and then it gaps lower, and you can see there's you got this period, or you got this area in here where there's no price actions gaps. So they call that an island. Just a little bit of technical structural sort of information. I don't use it as a great charting pattern or anything, but yeah, it's just a point of interest for those who like their charts on island reversal. It's, as I say, the trend's still up. We've still got those rising moving averages, but it does do plenty of near-term technical damage at best. I think it now takes time to trade sideways and re-establish some support. Get much follow-through selling, it probably does start to break down. Although stocks often don't go from a high level and then just keep going. You often get initial sell, then you get a rebound, and you see what the rebound looks like. The rebound can tell you a lot. If it's a shallow rebound which can't gain much momentum, then it sets the stage for another decline. The way I'll handle this is I've got the trailing stop. I'm just trying to remember where I bought in, and I think it was before this sharp move higher. So I use a time exit as well. So for instance, if I'd bought in December, it would be now maybe approaching a time exit for me, but I don't remember where I bought in. I could have bought in at lower levels. So assuming I'm in at better levels, and I've got quite a few stocks in my portfolio, so I don't know where I got into everything. But I look at this, as you can see, I don't have any great concern over it. It's one of many relatively small trades. So I'll just use the wide trailing stop, see if it can stabilize. Not a dip I want to buy. I don't want to buy sharp declines back to the moving averages. I want to buy more these gradual pullbacks to moving averages, not sharp declines. So yeah, that would be the state with PPS at the moment.
All right. The next one's RZI.
So we've got a trifecta of my stocks. I got this one too.
Using your service.
Well, yeah, it's nice to see this one hasn't gapped lower like PPS. Pulling back to those moving averages, like got really stretched above the moving averages. And so it should be expected that it's having a pullback towards the moving averages. So there's nothing unusual there. That's why we use those wide trailing stops. I don't want to buy this dip because it could turn into, it could keep pulling back further, or it might go into a lengthy sideways range for weeks or several months. because that is a big rally. It's gone from 40 cents to it's up 100% thereabouts in the space of a couple of months. So it'd be completely normal for it to consolidate. I'm happy holding it. Wide trailing stop. My stop will be down below the 100-day moving average. So I'm happy to risk giving back a good portion of this move for the potential of staying on a much larger move should that occur. And if it doesn't, well, that's okay. It's but the only way I can get those really big moves is if I'm prepared to give back a good portion of initial gains. It's not those good modest to moderate profits I'm after. I'm after the big triple digits, and I get them by giving these stocks plenty of room to move around. But not keen to buy into this one at the moment, but happy to hold it.
Okay. All right. The next one's WTC.
So this was in the news last night. So it's certainly not a buy the dip. From my perspective, I wouldn't be buying this dip, and if I had it, I think I'd be selling it. I'd have my trailing stop, but I'd almost certainly be selling this one when I think. If I was in, look, just measure it out. It's 36%. So I think that would trigger a wide, trigger most wide, even volatility based trailing stops as well, most likely. This doesn't seem to be a stock to be in at the moment. If I was in it, particularly from any of these levels from say November, if I'd bought any time in the last few months, I'd certainly be getting out saying, look, this is just not working. I've got to just cut this one. If I was in at much lower levels, it'd be based on my volatility-based trailing stop, which would be getting pretty close to triggering.
Yeah. All right. The next one is.
And sometimes just these things, you just don't really have the warning that they're coming. If we'd looked at this last week, it would have been, well, it's trading along moving averages, which are going sideways. It's neutral, but I'd give the benefit of the doubt to the incumbent trend, which was up. So I would have said, look, I'd be happy holding this one, have your calculated stop loss, and then it was announcements from the company which caused a gap lower. You can't. The only way you can you can't see that sort of thing coming. It wasn't like a stock which was in a downtrend. So it wasn't like Star Entertainment, which has been trending lower for 2 years, and then management come out with something negative. Well, you probably shouldn't be surprised they've come out with something negative because it's been trending down for 2 years. But when you've got a stock which has been in a large uptrend and it's trading sideways, you will get blindsided from time to time by these things that come from the company, and you can't see that coming. So we manage that by having many relatively small trades. So if WiseTech is one stock within a 2-stock portfolio, it's been an ugly day. But if it's one stock within a 20-stock portfolio, well, it's disappointing, but hey, it hasn't caused that much damage from a percentage perspective, at least. So that's how we have to try and manage these events, which will happen. There will be these surprise declines, and if you have a highly concentrated portfolio, you're going to have a volatile portfolio when these things happen, and that's how I avoid that. Many relatively small trades, not a handful of big ones.
Yeah, it's a good point you make, especially around this time where obviously the market's going down at the moment, and we've got a bit of volatility to the downside, and we're getting, like, even in my stock portfolio, I think it's a good test of your resilience and being able to, one, stick to your plan, and two, manage these situations where, as you say, the companies have come out with something you've blindsided, you've no idea has happened, and how you're going to manage your way out of this one now, right? But sticking to your plan is an important thing, I think. So, there's a question around trailing stops later on, but we might get onto that after we've done a few more tickers. Let's get on to HAV, please. HAV.
Not really doing too much. It's really range bound. So there's probably not really a great deal for me to do with this one It's just really trading either side of the moving averages. I'd probably leave this one alone. You can draw some resistance that comes in at around 24 cents. It probably needs, at this point, needs to probably break above 24. Oh, what's that? Yeah, it probably needs to get to around 25 and a half cents to say 26 cents. Say, okay, there's a bit of a breakout happening. Until that happens, I'd probably just leave this one alone. It could keep tracking sideways for months or years sometimes, and they just don't go anywhere. So you can sort of stock you can keep on your watch list, keep an eye on it, but there may be better opportunities with the capital, which could be stocks moving now, which are worth having a look at, and rather than tying up capital in a stock which is tracking sideways.
Okay. Next one on the list is our ASX, the ASX. I shouldn't say our ASX, but the ASX.
Yeah, this is just being volatile. There's no underlying trend here. It's this is just one which it started had the makings of some momentum coming in through late last year, but then it just failed on that. So really, you can say, look, it's a bit of a false break high, and it's come back to the averages, starts consolidating below, then picks up some downside momentum, but now it's whipped back to the upside. I'd just leave this alone. Maybe with this one, it's a case of, like, you can probably say there's some overhead resistance around those previous highs. They kind of line up around 69-ish, not an exact level, but thereabouts. So if prices were to consolidate below 69 and then start to break higher, maybe up around 70-ish, that could be a breakout to go with. Maybe this is a basing structure that it's currently working on, but the momentum's currently not there for me to justify anything. If I was in this one and I had something better to do with the money, well, maybe I'd probably sell it. That said, if someone was in this and they've got a positive view on it, I guess risk can be managed. This low point from January is probably pretty key. If this rally quickly fades and it can't hold on to those gains and prices keep slipping, break below that low, that would probably be a good point to say, look, this isn't working out. But yeah, I'd be inclined watch it, see if it consolidates below resistance, see if it breaks out. That could be the trade.
Okay. The next one is WDS.
And this has been, the oil price hasn't really helped this one get going. It's been trending lower for over a year. For over a year, this has just been leave it alone, go away, do something else. There've been several instances where people have asked me to have a look at this one when price has been rallying, and each time I've said, look, that maybe this rally turns into something, but for me it's too early because the moving averages are still in decline. And sure enough, all these rallies continue to be sold. What happens here? Of course, I don't know. This could be a basing process, or it could just be another holding pattern before lower levels. So I'd be inclined just to steer clear of Woodside and Santos for that matter. Santos has been a little bit stronger in recent times, but they've both still got these declining moving averages. Until that changes, and look, maybe this is the bottom, and someone will say, "Hey, that I told you that was the bottom, was staying to base." But then, just as it could also be a case of you get in now, and in 12 months' time, it's either going sideways or it's even lower. You're not buying into any momentum. At the moment, if you buy at the moment, you're buying on the hope that there's going to be a base sometime soon. I don't want to buy on the base of hoping something could happen. I want to buy on the basis that something is happening. It may not keep happening. A breakout may not keep happening, but at least it is happening. I'm going with the momentum rather than hoping momentum is going to develop in the way I'd like it to, because at the moment it's not doing that.
Okay. All right. The next one is DRO.
Last year's hot stock, which turned, which fizzled out. I don't see the trade here in this one at the moment. Like, it's had this The thing is with these stocks that do these huge runs, they often don't. Sometimes they do, but often they don't repeat that run, at least anytime soon. But for a while afterwards, people are looking for an encore performance. Now that could happen. That's a nice strong rally from below the averages to above. I'd at least want some more price structure. It's hard to even get the right scale on this given the portions of the chart. I'd probably look for me if say it's a nice initial rally. If we saw some like sideways price action, the moving averages started turning higher, and then from there prices broke higher again. Well, I could, yeah, that could be a move which I'd be inclined to go with. But at the moment, it's like there's not enough there. It's like some of those rallies we just saw on Woodside, where it rallied back, maybe get a touch above the averages, and then the rally gets sold into and starts to come down, makes a new low. So I'd be careful with this one at the moment. I wouldn't be in too much of a hurry to be getting in there and doing much. And you can't even say, look, I'll buy here and I'll put a stop at the low, because that's a fair way away. It's about 40% away. So probably not for me. I think see if some better price action develops, but one to be careful with at the moment.
All right, next one's SVR.
Well, it's starting to come back from what was it's getting a bit vulnerable. This price action here was below the pretty much below both the 50 and the hundreds. So it's good to see it flip back up to the top side of the moving averages. And so this broad, it's not really a broad trend, but it's an emerging trend. I've actually got some of this one myself, which I probably bought back maybe around November, somewhere around there perhaps. Uh, so I've just been using my wide stop, which is still below where prices have been. I'm happy to continue holding it, see whether it can re-engage some upward momentum. And sometimes you get this. You get stocks which have a nice strong initial run, and they give it back and they consolidate some more, and then they regain their momentum. It's not a terrific structure. It would have been better had it run and then it held those gains and went sideways rather than coming all the way back. But hey, it's back above the moving averages, so I'm happy to keep giving it the benefit of the doubt until it hits my trailing stop.
All right, next one's OCC.
But I probably wouldn't buy this one. It's not a setup which I particularly like. It's one I'm happy to keep holding, but I'm not enthusiastic to buying it, particularly in the current environment. If it looked like if we had that sideways into the moving averages and rallying off, then I'd say, look, I like this. And this is a good example of how every setup doesn't work. It was a great setup. It got some nice initial gains, but then it gave it all back. So we don't know which setups are really going to go on and deliver the big returns. So it's a case of go with many, and a few of those many odds are will give you those big gains. But then there are going to be plenty of others which just don't deliver. We'll see which camp this one ultimately falls in as time goes on. OCC. It's had a really big run, hasn't it? So we shouldn't be surprised it's come back to the moving averages, particularly in a volatile environment. If I had this, I'd keep holding it. I'd be using the wide trailing stop, which is going to be still some way below the 100-day moving average. And the reason it's so far away is because there's been so much volatility in the share price. Like, look at some of these ranges. Like that's what's that? That's a 20-cent day there, and it was only back last September the shares were valued at 37 cents. So that's almost like 2/3 of its price from mid last year in one day. So there's been a lot of volatility in the it's been mostly upward volatility in the share price. There has been some large down days as well, and this all contributes to a wide trailing stop. It's just how the calculation works out when you use a volatility based stop, and it's so wide for that very reason, because you're getting these big swings in the share price. I'd be happy staying with it. I'm not keen to buy this move, pull back to the moving average at this point. It's a fairly quick pullback. I'd like to see it stabilize and rally and go sideways for a while, and then potentially look at buying another breakout. But like where this one's going to go, I don't know. That's it's like from 34 cents to $1.75 in a few months. It'll be interesting how this one works. This is one of those times where if you get a really large gain, where sometimes I would consider scaling out of the position. It's probably not big enough for me to scale out, but it's more probably when they get 300% plus, I sometimes, or 400% plus, I sometimes might sell a third. That's always scaling out. It's always an option for people who see big profits and get uncomfortable, rather than waiting for the wide trailing stop. Maybe taking the top of it, could be a third or a quarter or a fifth or a half or whatever works for individuals. But generally, though, I'd be letting it run.
All right. Next one is NVDA, NVIDIA.
NVIDIA. So is there a structural change going on? It's too early to say. So we've got this period where we've just gone sideways along the moving averages. It's fallen beneath the averages. Quick rebound above, and now it's threatening to come back beneath. So the sort of price action I'd be on guard for would be if it comes back and we get that sideways consolidation as the moving averages are rolling over, and that becomes a vulnerable position. And vulnerability doesn't mean it's going to break down, but it means that it can. Then you start being on guard for price action, which continues to extend to the downside. That, of course, may not happen. That's why I say I'm watching. Are we seeing the signs that there's a structural change in process? At the moment, I'd say, look, this is still range bound. Probably like watch the February low on the downside. On the upside, we've got these previous highs, but they're not being threatened in the current environment. It's certainly not what I'd want to be buying here at this point. If someone's had it and they've held it for a long time, it's that wide trailing stop. Let's just quickly put one on and see what it looks like. So I've set this up so it'll just be a standard 10 ATR. And let's say it was bought. Got to get that off so I can see the chart. So it's interesting, isn't it? So we can look at the price action, and that's where the moving average is crossed, and there's our breakout. So let's do it from there. And this is what could have happened had you been using a 10 ATR stop with NVIDIA. You could have been in at around $20 and sat through consolidation one, sat through big pullback, sat through an even larger consolidation period, just held in, and it's rallied again. You're still in it, and that's where the stop is now. So in at 20, maybe out at 100. So 5 times. That's pretty good. And that's what the wide trailing stop can do. Now, someone will probably groan and say, "Oh, but look at all what you're risking giving back." But just think about it for a sec. How did we get in this position in the first place? Well, I'm not in this position. I'm not in NVIDIA. But if you were, how do you get in this position in the first place? You get in this position in the first place by being willing to give back profit to stay on a broader trend, a larger trend for as long as possible. And if you're selling out every time there's a 10% pullback, forget about it. Forget about NVIDIA. Forget about the stock market. It's not for you. It's that's what we've got to do. That's what the wide trailing stop does. So it will give back profit at the end. But as you can see with NVIDIA, it's kept you in since, say, February 2023 in the boom stock of the last 20 years or something.
All right. Let's get on to SLX. Ouch.
Yeah, well, this is it's been a messy stock. really. It's like we get these consolidations, get breakouts. The breakouts don't extend; they come back down, and then it starts to get going again. Pulls back abruptly. It's a messy stock. It's not. And it's been a difficult stock for some time. There's probably let's see what the next rebound looks like. There's probably going to be often you'll get when you get these sharp moves from above the averages to below, you often get the rebound back towards the moving averages. What's that look like? Is it a sharp rebound, or is it a muted one which just travels sideways, which then sets up more vulnerability? It's not a stock. I certainly wouldn't be buying it, and if I had it, I want to know where my exit is, and it's a stock I'd be close to moving on.
Okay, the next one's BGA.
Oh, BVA. Was that it, Rog? BVA?
There's no BGA.
Oh, GA. Oh, bigger cheese.
Oh, yeah.
It's been a great trend, and now we've got a sharp decline. There's been so many of these in the last week, like abrupt moves, like more so than we've seen in the market. It's I imagine it's something to do with the results. We're in that reporting period, and it's if a stock has missed those expectations, there's been this tendency for these abrupt sell-offs. I think the current environment is adding to that nervousness. At this stage, the trend's still in place. Wide trailing stop would have you in this stock. So I'd be saying, yeah, if I had this, I'd keep holding it with my wide stop, see whether it stabilizes. It's been a big trend. It's not unusual for big trends to have some volatility. It's like we saw NVIDIA. There's lots of volatility in that. The key now is it's come back to just below the moving averages. Can it stabilize and get back above the averages? It's done some technical damage. Maybe it needs some, at best, it probably needs some consolidation, some sideways. So I think the fun's over for the time being. I think this does sever the immediate upward momentum, but I wouldn't write it off yet. There is still that underlying trend is still in place. That's why we have these wide stops to see off these periods of uncertainty, and they're unpleasant, and nobody likes them. But that's what we've got to do to stay on big trends. At this point, I'd be holding, but not buying just yet. I want to see how the next maybe few weeks, next month or two of price action stacks up. Does it start to stabilise and push higher, or do we see that structural change we've already talked about when we went through the ASX start to unfold?
All right, next one's MSB.
Yeah, trend still in place. Pull back to the averages, holding onto its gains at this point. So you can see that the strong move it had off the December low. This is just at the moment. This is sideways into the moving averages. So the trend remains in place. It's theoretically, yeah. Look, this would be a buy the dip point. I don't know that I want to be buying dips at the moment, just with our current environment. If we're in a normal market, which is just it's just gradually ratcheting up in a quiet upward trend, this could be a buy the dip point. But with the heightened volatility, I'm not so keen to be stepping in and buying any dips in this environment. So I think it's the wrong environment for buy the dip strategy. If I'm buying anything, it's probably going to be buying a breakout. And even then, it's like, well, just mindful of what the broader market is doing. But happy to hold it. Wide trailing stop. It's a volatile stock, MSB, and it's one of those ones which is prone to downward surprises as well as upward surprises. But at this point, for me, it'd be a hold with wide trailing stop.
All right, TAH. I used to work
trend. And trend still in place here. From below the average to above, we've got the nice consolidation into the moving averages. Another rally, consolidation back to the averages. Another rally, holding up well, and that's also another good sign. It's been holding up well in the last last week, despite all that volatility we've seen in the broader market. So this is a stock I'd be happy to hold. If I wanted to buy something, it'd be a one to consider. In that it's always positive when a stock holds its own despite broader market volatility. Often they'll struggle to continue to really power ahead during periods where the market is soft. But if the ASX stabilizes and the environment settles down, well, then we could really see a trend here start to develop. So one I'm happy to hold. Usual wide trailing stop. One to consider an entry for if it interests you.
All right, NEM.
NEM, was it?
Yep.
Newmont?
There's one in Australia as well, probably the same thing. Probably
Yeah,
same
it'll be the same one. So they've taken over Newcrest's listing, and probably have to look at the US one really just to get the depth, because it only kicks in from when they took over Newcrest. So if we look at it on the US listing, it's been some of the big gold stocks, Newmont and Barrick, they've just been disappointing. They haven't participated in the move in gold like some of the mid to smaller tier gold stocks have. And like when you look at this, we're going back to 2017 just on the scale I've got here. It's just so far from the highs from 22, yet gold's at an all-time high. It just hasn't been working. So I've got exposure to Newmont through GDX, a gold ETF, but I don't have any individual Newmont, and I don't want any individual Newmont at this point either, because there are other stocks. I think other gold stocks look better. Yeah, it's gone from below the averages to above, so maybe the structure's starting to improve. If it can hold on to much of this recent rally from the December low, maybe it sets itself up for another rally. But I'd prefer to buy the stronger stocks within the gold sector, not the ones that are lagging, hoping they're going to catch up. It is one of the more disappointing gold stocks which are out there. Look, there could be a basing structure in place. Like you could, that's got the makings of a head and shoulders type pattern. There's your left shoulder, the head. Maybe that's the right shoulder in development. But it's just, what can I say? Disappointing for a gold stock in this environment.
All right, next one will be TLX, please.
Yeah, uptrend still in place. Well, buying the dip back to the moving average worked there, although I would have said, look, I don't want to buy the dip at this point in time. But these are if you want to buy dips, these are the dips. Strong trends that come back near moving averages. Even in this period in September, as it started to rally off the moving averages, these are the dips to buy, and this is the rally to hold. Let profits run, wide trailing stop. See where it's going to go. Who knows how far it goes? But at the moment, the trend is in place. There's no sign of it stopping.
All right, we've got CVB.
Yeah, there's not really a lot for us to go off here. Look, I'd be leaving this one alone for the moment. There's some this from below the averages to above and coming back to the average. That's kind of interesting. Maybe that's worth watching. If it just continued to build a bit of a sideways ranging structure and then start to break higher from that, maybe that could be something to go with. Yes, there's a bit of a sequence of higher highs, but it's not met with a series of higher lows. There's not enough here for me. Something could develop out of this, but I don't think there's enough there at the moment to say, look, hey, we want to buy it here, and you can't even say, look, let's buy it here and put our stop below the low, because percentage-wise, it's going to be unpleasant. It's going to be like, there you go, it's 36%. So to say, look, I'll buy it now and I'll put my stop just below the January low, do you want to do 36, 40%? It's like, it's too much. So it's a hard one to manage. So I'd probably leave it alone.
All right.
That's it. Look, there could be a great story there, but we don't know. I've got to manage the risk, and we don't have enough of that momentum to go with.
Yep, that's exactly right. FND.
No, look, there's nothing here for me at the moment in this. It's just that volatility. Nice trend turned into a sharp decline below the moving averages. It's just swung back to the upside, but maybe this is part of a large ranging period. I don't know. It could re-establish some momentum from here, but these big declines tend to do a lot of technical damage and then take a bit of time to recover. So I'd probably be rally back. We've got this consolidation area, another breakout. If it were to then now like have a bit of a pause and we see those moving averages start to turn, and then from there we get another breakout, that could be an entry point. But I just don't think there's enough price action to say, hey, look, I want to come in and buy today. Now we've gone from below the averages to above. Maybe we see that consolidation, and if it's a good consolidation that holds on to its gains, then that could be a sign there's buying underpinning prices, and that could lead to another round of momentum. But let's just see how this one develops just now.
All right, we'll look at WOW, WOW, please.
Yeah, moving averages are still in decline. Yeah, look, it's not a stock with upward momentum. I wouldn't call 3 weeks, a 3-week bounce off the lows upward momentum. It could turn into something, but it's not there yet. I think we need a whole lot more price structure before we can start looking for opportunities in Woolies. It could base here and turn higher, but what's to say that this is a point it needs to turn from? It could just be like we saw in Woodside. It could be just another brief pause, rally to the averages, another case of sell the rally, and it's back at lower levels. It's the path to least resistance. It does seem to still be favouring the downside, notwithstanding a 3-week rally.
All right, the next one is ASL.
I had this one, and it was a motion trader stock, but it hit its trailing stop. Trailing stop in mid-December. And this will happen sometimes. A wide stop will trigger. Stock will fall a touch further, and then it'll rebound. And this is the number one reason a lot of people don't sell when prices are falling, because they tell me, but what happens if the stock rebounds after I sell, like this one has? And it's like, well, so what? It's stocks that rebound. The stocks that rebound don't destroy your portfolio. It's the stocks that you don't sell that continue declining. They're the ones that become the lead weight. So it's like, I look at this and I'm not disappointed that I sold, because I was managing risk, and the worst outcome for me was I didn't sell and it ends up down here. That's disastrous. This is just, it doesn't matter. It's I made a great profit riding the trend, and it gets a point where these pullbacks become large enough that you do need to look to move on. Having been through the sell phase, though, is this now starting a new upward phase? It's possible. It's gone from below the averages to above. We're getting this consolidation along the averages. It's like if someone said, "Look, I want to buy this dip back to the averages." Probably, I'd say they'd probably be looking at maybe close to a 20% stop. Probably needs to be maybe below, looking at this little cluster of lows from late January, a bit below there, below the 100-day moving average. It's probably 20% to have that punt that, okay, this sideways is going to be a dip to buy, and upward momentum is going to resume, and that could happen. It's not a play without merit. The other option would be whether we get more sideways consolidation and then potentially buying a breakout from that consolidation, or buying a dip a little bit later on once this has built out a little bit more, because I get a feeling this might need a little bit more time to build out. But it's a stock worth watching. It's one of those. Look, I don't know whether it's smaller or mid tier. I don't know much about it. Even though I've owned it, I don't know that much about it because I'm more focused on the price action. But it's something could develop in this. It's one worth having on the watch list if you like this segment of the market and want a stock which has shown the potential to do some interesting stuff when it gets going.
All right, I'm going to shout out for Jennifer here, who's given you a shout out for your service, Jason, as a loving member of the system with many winners. Could you give me an update on MAU, which is a gold stock? It's moving up nicely.
Absolutely, we can. And it's great to get that feedback. Thank you, Jennifer. So let's see. So I've got this range drawn in from a previous time, a nice trading range, broke higher from, but then it gave it back. It wasn't able to sustain the momentum at that time. Now it seems like it's like going through another basing phase. So this is similar. It's actually quite similar price action what we just discussed with ASL, in that we've gone from below to above the average. The averages are crossing. Like, do we get a period where we just get a bit more of that sideways ranging and then break up from there? So, or break higher from there. So my preference would be just to watch it, see if we get that sideways price action, see if this latest rally is well supported, that it can hold on to most of those gains, and plenty of ifs. But that's often how it is when we're looking at some of the price action, because we don't know. But if we do get that sideways price and a break higher, that could be a play. There's certainly some potential in it. It's showing the potential to trend, but it wasn't quite ready to run mid last year. Maybe this will provide a basing period which will allow a larger rally. Too early to say. Don't think it's ready yet, but certainly worth keeping an eye on.
All right, we'll do one last ticker. 3DP, interesting structure, but stop loss could be hard to manage.
Yeah, it is, isn't it? So it's gone from below to above the average. So really got this strong rally. I like that let's put the Fibonacci's on. You'll see this will work right into the fib zone, right to the 50%. So it's got that nice balance of rally and pullback. So I think it's a nicely proportional in terms of the rally and then the pullback. It's rallied off there nicely. And that is the issue. How do you manage the risk on it? You're looking, if you buy today, I think you're really kind of looking like 31%. Like, if you buy here and say, look, I'm just going to give it 10%, like 10% is to here, and that could be just tomorrow's range. Could open, come back down 10% in the session, and then close back at the highs. It's too hard to manage the risk. It's a leap of faith to buy today with a 10% trailing stop, or not a trailing stop, a stop loss. It's like I want to get the stop below some sort of structure, whether it be below these previous lows or below a 50-day or below a 100-day moving average. It's there's too much we could say there's too much air, too much free air in between, so it's harder to manage the risk. But the structures, it's an interesting one. I like the impulsive rally. I like the corrective pullback that held on the most of its gains. Maybe it's a case of like watching it, and then if we do get like another consolidation, and of course the moving averages are catching up, then maybe it's a case of like picking up a dip down to 8.5 cents, or if we get that, then maybe it's buying a breakout from another consolidation. Then the stop can be at a higher level below the consolidation which may form. So it all involves new price action developing. We've certainly got something which is worthy of watching, but now it's like, can we get the right setup to get an effective risk reward entry point?
All right, fantastic, Jason. I do want to. I mean, I know we've touched on it many times in this show, particularly because we're in this, phase. Well, last week where the market's just going down, we've seen a lot of stocks that have just taken a bit of a dive, right? But let's just get on to Terry's question once again, right? Just as a bit of a confirmation for everyone and what we teach on this show. Obviously, we're not telling you to buy or sell. That's up to you because you might have another reason to do so, right? We're just giving guidance around some of the rules and things that we use, right? That's a general guidance show. If you've got another reason to buy or sell, that's your choice, right? But so we're not going to here to tell you you need to cut, you need to sell, or you need to buy, right? But on Terry's question here, let's say a stock has dropped more than 40%. We'll use CXO as an example that he's given. So you want to bring that up? I knew I should have a tight stop loss, but emotion sets in. So should I just cut losses and sell them?
Yeah, and so wonder where Terry's saying his entry point is for this, because this has been a long decline for going on for ages. And if he's down 40%, it must be a fairly new entry. I'd gather. I'd be guessing. Oh, look, I don't know. Maybe it's somewhere in that late 24 period. Like, and you summed it up nicely, Rog. We can't tell people what to do because someone tells me, look, my stock's down 40%. Should I sell? And I say, yep, cut it. And then that's so low, and then it starts to rally. They say, oh, you told me to sell, and it's gone back up. I don't know. I can't see the future. All I can do is like make suggestions to say, look, hey, have you thought about how you're going to manage your risk with this one? So it's down 40%. What if it halves again? Are you okay with that? And they'll either say, I'm 100% not okay with that. So, well, there's your answer. What you should do now. If it halving again is unpalatable, you've got to do something about it now to ensure that doesn't happen. Or if you go, well, it'd be annoying, but I'll live with it because I think this is going to be the next great stock. It's like, well, maybe you're going to hold it then. So you got to balance your regret. What's your biggest regret? Is your biggest regret going to be holding it and watching it continue to decline, or is it going to be selling it and watching it rally? For me, my biggest regret is almost always holding it and watching it continue to fall. That's just for me an unforgivable act. Knowing everything I know about cutting losses to hold something and watch it turn into a wipeout would be just awful. Whereas if I sell it and it doubles, it'll be like I'll get the next one, but I can live with that. So that's how I balance my regrets, and that's how I think everyone should approach it too. Just ask yourself the what if. What if it halves again? Am I okay with that? If the answer is no, you've probably got your answer of what to do next.
Oh, I think that's a perfect response, Jason. Thank you. A lot of these questions are, once again, without preparation. So I hope that helped, and I hope that helps everyone. We've gone for a decent amount of time today, so thank you very much for joining us once again. Just remember, once again, we're a general advice only show. So just as I stated before, you've got to make your own decisions and do your own due diligence. If you want to check out Jace's show, he has shows as well on his own YouTube channel, then go over to motiontrade.com.au and there'll be links there to his YouTube and his service as well. If you want to check out Selfwealth, go to selfwealth.com.au. One of the beauties of being in this position, once again, is getting the compliments, not just through the show, but also via email, where you get clients, the people that can't make the show anymore, they still want to watch the replay, Jace. So, it's a good position to be in. But not only that, you have a lot of clients telling you their stories, why they might come to a service like Selfwealth or even Motion Trader, because of brokerage or because they had education that wasn't as good as what you offer, Jace. So we get many of these stories. So if you want to be part of that story and you want to be part of Jace, go and visit him. If you want to be part of Selfwealth, then come and visit me, obviously. I'm here to answer any questions you have. Other than that, look, it's been a great show once again, and it's good to be in a show where not everything's going up. It's good to be during a period where things are going down and how we're going to be able to manage these periods of going down, right? So let's see what happens over the week. Thanks, Jace.
Hey, Roger, that's been fun. Hopefully, our viewers have enjoyed the show. Hopefully, we've got through all the stocks, and yeah, look forward. Come back next week, have another crack at it.
Beautiful, everyone. Well, thank you very much, everyone, and stay safe out there. Take